Hey everybody, Michael Brooks, and I know it has been some time, and I'm not going to list a whole bunch of excuses at you through this video, but just to let you know, I am on a new trajectory for 2025. I'm going to talk a lot about it today in this video. I have a lot for you. So this is going to be a long one. I'm going to just kind of start with a little bit of hey, where are we at as a firm? What is the plan for 2025 as far as content? What am I trying to get accomplished this year for you? And also diving deep into the kind of foundational subject of, especially when you first become a client, but even if you haven't reviewed this subject in a long time, I think this is going to be a really good representation of what I'm trying to get at when I'm trying to communicate the concept of asset allocation. What does it mean? Why do we use different asset classes, and what are they, and how are they implemented in a portfolio for your retirement? So anyway, I wanted to just kind of introduce it like that. Let's get started. Okay, so a little bit of this housekeeping first. So what I wanted to kind of do here is just talk briefly about where I'm putting the whole kind of package together, and I wanted to introduce you through this concept through my website. And so if you can just see here, I'm going to switch over to where you can see my website here, and I've kind of had a few changes that I've made some updates to. So if you can see here, one of the key tabs I've done a lot of work on is this investing tab. So if you check over on perfettacapital.com, and then you'll see these tabs up at the top in investing. Now I'm going to be going into a much deeper dive into what all this means in future videos. Because this investment philosophy may be some new vocabulary that you're not used to. We're going to be unpacking all of this, but a lot of these key questions that typically you get from clients, from folks that are looking for, hey, what kind of, and why did you pick the investment strategy you did, and why are you different than what everybody else is doing? This is a great example of some key questions and how we just kind of take down those arguments of what a lot of people have misconceptions on. So take a look at this on each of these subjects. Here, these questions are a great Q&A. I've got 10 of them listed out. And really where this comes from, this is straight from Dimensional Fund Advisors. They have a great job of coming up with a lot of these kinds of client-facing materials, and nobody has done it better, I've seen, as this kind of 10 question with a lot of charts and graphs explaining the basic concepts of investing and why we do things the way we do with our asset allocations. Okay, so I wanted to show that to you. The other thing that I wanted to point out is this for clients section. If you haven't looked at it yet, you can easily get to the key documents for the firm, for Perfetta, which is the client agreement, which we need a signed agreement for every client in order for us to continue to do business together. I've gotten most of them back. A few I need to track down, but those are critical for my records to have. And you will also should have received the Part 2A and Part 2B and the privacy policy either when you signed up for an altruist account or on request. We can send you one, and those will be updated usually annually, and we'll be emailing that out to you as well and providing it an updated version on the website. And lastly, the client links. If you ever forget where to go, we have a client link for the custodian, which we're using either Altruist or Schwab. And the Right Capital is our financial planning software and portal, which I'm trying to get a lot more folks onto, and that's a big project this year. I'll be going into depth and again in more videos and showing you exactly how I'm taking a person from, hey, let's start with ground zero and how do we build wealth over time, or hey, we're pre-retiree, very close to retirement. Are we going to make it or not? What are some adjustments can we make? And I'm going to show you a lot of those kinds of examples through right capital. Very visual representation of financial planning. How do we meet your goals? How can we project into the future some of the possibilities that we have to maintain, grow, and maintain wealth? And finally, for those of you who use AdviseOn, this is very few of you, and this is sort of our top tier wealth, our legacy tier group, where we have very in-depth performance reporting. And those of you who have a login, it is there for you. But really, if you have Altruist, you kind of have that whole package of the performance built in. So you don't really need to worry about it unless you know that you have an AdviseOn portal. But I wanted to point that out to you as well. Lastly, I have added the scheduling a meeting with me right here as a tab under scheduling a meeting, and you can schedule a time with me right here. Now I put different steps, and that's kind of an onboarding for new clients. But really, it doesn't really matter which one of these you choose. This will pop up into my calendar. And if you would like to initiate on your own an account review, or you have a question, please click on one of these, either the purple account review or the support call. Or if you want to really dive deep into one of these other subjects, just to give me clarification on what we're meeting about, you can. And you just click on this and find a time that is convenient for you, and you can see my schedule here. If there is a time that does not work for you in this automated system, I really highly encourage you just reach out to me, email me, let me know, hey, we would really like to get something together, maybe with me and my spouse, but we don't get off work till 6 o'clock or 7 Eastern time. We may be in the West Coast. Let's figure out a time together. I'm always going to be available to make those kinds of exceptions, so don't let this bog you down. But I really want to make sure that we're meeting, especially for folks who we haven't met in a while, for just getting back up to speed. Let's make a plan. Let's figure out where we need to go from here. And I want to get this under wraps this year. Okay, so that's kind of where we're at with the website portion. So this year, my focus is to generate a lot more content, really educate about some really basic concepts here, plus have some deep dives into some of the investment stuff. The other thing along with getting into some right capital and goal planning that I'm really going to focus on, especially with a certain chunk of folks this year. I can't do everybody because it's a lot of work, and I have to kind of tier this selectively. But a lot of folks, I'm going to be working with a new estate planning tool that I have acquired this year that's really going to be effective at getting basic documents needed and legally down on paper with your state, that takes care of things like a basic will, durable power of attorney, and healthcare directives, etc. And that is all going to be available to my clients for free for a basic document set. And we're able to do that in combination with an AI built into the software package. And it is also backed by a whole slew of on-staff attorneys available in all 50 states, which I was never able to do because I'm in Georgia and my relationship with attorneys are only available here in my state. Usually, maybe in one other state, but attorneys stick to their state. Well, now we have a national service and able to do this and to get some basic documents down. I will be sharing that in a future video, but that is something very exciting that I have been working on a lot over the holiday weekend time here, and I will be sharing that with you shortly. So just some kind of broad overview of kind of my target topics that I want to be highlighting this year. But first, I'm going to be covering a very in-depth view here. This is going to take probably, 15, 20 minutes, but I want to cover a presentation covering a very basic concept of what asset allocation is, why it's important to figure this out, and why it's important to figure it out in the beginning for each client, and figure out what model is appropriate for you. So let's dive right in. Okay, so what I wanted to explain to you in this video is understanding what asset allocation really means. It's a term thrown around a lot by advisors, and you may hear it here and there. But typically, when you're watching, the news and you see kind of the stock tickers at the bottom, or you may see in the bottom right-hand corner of a CNBC or a Fox Business on TV, for instance. Or you go to a financial website like Yahoo Finance or Google Finance, you're going to typically see three indexes that are shown: the Dow, the S&P 500, and the NASDAQ. And those are representative of U.S. stocks. And so when we look at those indexes, those aren't really asset classes. Those are indexes of one asset class, which is U.S. stocks. And so I'm going to be talking about other asset classes in here and why we're only using a couple. And we're going to get right into depth going right now. So what does asset allocation even mean? Well, there's a cool kind of little website. I'm not even sure about, you don't even need to sign up for it, but I just grabbed some of their graphics. They put some pretty interesting graphical representations of some financial concepts. I wouldn't take everything there to be gospel, but a few of them I do like. So I grabbed this from Napkin Finance, and they do kind of a cartoonish version of explaining some basic concepts pretty visually here. And what I'm just trying to show you is what an asset class is a category of investments. And so you have, ownership in companies is what stocks are, loans to companies or bonds. We have money in the bank, which is cash. And then you have a whole nother section, which is alternatives. That can include things like real estate, crypto, gold, futures, art, maybe even currencies, all sorts of different alternatives that are outside the publicly traded stocks and bonds and cash that you kind of typically see out there. So what do we invest in at Perfetta? Well, we invest in stocks, bonds, and cash. The alternatives, I typically say, look, we've got so many other things to take care of first. You've got to make sure that your goals are set and ready, especially for retirement, that you have a very, very secure goal in mind, that you know that there are not going to be interruptions into that goal, and that your investment plan is very much tailored to that goal, and we use stocks and bonds to cover that retirement goal. And some other goals you may have are also important in that mix, but once we have those set, maybe then for, funny money or some extra, play money, you can look at some alternatives, things like crypto or gold or some other kinds of alternatives that are out there. But I typically recommend staying away from those kinds of asset classes. The main reasons are a lot of them are illiquid, meaning you can't access money at any time because they're not necessarily publicly traded. Very much so with things like hedge funds or some of the alternatives like real estate, etc. Speaking of real estate, right, the reason we don't even have real estate in our portfolios for the most part, which a lot of portfolios out there do, is because I think that most people are already highly representative in their net worth with real estate. You usually own, when you build your net worth, you're usually owning a home at some point. You own property. Many people own more than one piece of property outside their primary residence when you really start to build wealth. And so you're already highly represented there. And that wealth, again, is highly illiquid. You're putting it into the ground. It's harder to sell than just, hey, let me sell a few stocks. I can sell them right away at any time during the day, during a market business day. So that's kind of just my rundown of why we're focusing on the kind of super asset classes of stocks. And this could be U.S. or international. We're going to break all this down later in depth, but just the major asset classes: stocks, bonds, and a little bit of cash for a different function. So what are we using these asset classes for? Well, stocks is very much the center of the story. I mean, stocks is where we expect to build wealth over time. This is our capital appreciation, our driver of returns. Stocks is where we expect to grow our money. And we're using bonds in a portfolio just as a ballast. We're just using bonds to bring down the risk of a portfolio to make it more conservative, the more percentage of bonds that we're putting in. And we do this just because bonds typically over time have earned more than cash has. And so you could have, a cash percentage versus stocks, but typically bonds have done better. So we use bonds to provide that ballast to take down the risk or the volatility of a portfolio that might consist of 100% stocks. And I'll show you that in a minute. And the function of cash we usually use for very short-term goals. And especially at Altruist, we have a very, very convenient way at our custodian to use a high-yield savings account to accomplish these short-term goals, such as 3 to 5 year time frame. Things like, hey, I want to save for a new house, or hey, we want to save for a wedding coming up for our children, or we may have a child who is 14 or 15, we want to get him to college, but we're very late in saving. We don't have very much time. How should we invest? Well, we're not going to take, probably 100% stocks in that scenario, because a 3 to 5 year time is just not long enough to give the kind of confidence that we should have when we're talking about long-term investing. We need more time when we're talking about investing in something more risky in stocks for the short term. So that's how we're using those three major asset classes. So how do we put these different assets classes together? Well, we construct 5 different models, and this is what I have put together for clients to choose at Perfetta, all the way from aggressive down to conservative. And what do? Well, it's pretty simple. We're just taking from aggressive all the way down to conservative, from 100% stocks down to 30% stocks. And again, we're using a greater increase of the percentage of bonds to bring that ballast down, to bring the risk down in the portfolio, for the percentage of stocks to come down as we go more conservative. So we start at 100%, we go down to 80, 60, 40, 30, etc., the more conservative we get. So those are the 5 models. And when I'm onboarding a client, part of the process is immediately we want to figure out, where do we lie in the aggressive to conservative line here? And that's the next subject. How do we find this out? Well, what a lot of investment companies do, and a lot of advisors are doing, they're using software to ask these questions. They're using risk tolerance questionnaire. You see this usually every time when you enroll into a 401k plan at your employer, or you're starting onboarding with a different advisor. You're going to typically see an online, with some of the other companies out there. If you go online on Vanguard or Betterment or any of these kind of online investment platforms, they're going to ask a few questions, and they're going to do this as a risk tolerance quiz. This is what you're going to see out there, because usually you're not, in those forms, you're not talking to a live person, an advisor necessarily. And so you're going to take this risk tolerance quiz, and here's my problem. So let me explain. The philosophical term for this is we call a recency bias. And this is my problem with taking a risk tolerance quiz, is when you take it is the issue. So if you have a bunch of questions, yes, time horizon, meaning how old you are, usually has a very big effect on these risk tolerance quizzes. They're going to give a bigger score based on your age. But they're also going to ask some questions about do you feel about a drop in the market of X percent. And how do you feel about that? Well, my problem is if you take a quiz on the bottom of the market, the S&P when it was at 670, and you're making a decision and taking a market quiz in the the beginning of March of 2009, after we saw one of the worst financial crises since the Great Depression, and you saw the S&P drop 50+% over the course of just a few months, and then you're asked to take a quiz on how you feel about the market, you're going to answer that quiz in a very different manner if you're taking that quiz, for instance, now, after we've seen over the last couple of years the stock market rising, and in just a 2-year time frame, similar, and that it's up 53%. So a very different kind of scenario, down 53, up 53. My point is just to illustrate your feelings about the market are going to be very biased towards what the last couple of years have shown, and that is just a big problem. In fact, going opposite usually of what we should be doing, which is when you do have a big market fall, you should be thinking, all right, well, now's the time to, if I'm going to do anything, I'm going to be more aggressive because we've had such a big pullback in the markets. So those risk tolerance questionnaires are actually doing a disservice to clients, in my opinion, by directing clients in the wrong direction. Okay, so if we are not going through just a quiz to answer which model do we choose, then what should we be doing? Well, if you are a client of mine, what I recommend is what we do to onboard clients and what we should be doing on an ongoing basis, which is we use a financial planning process through our Right Capital system to find out what your retirement goals are, or any other financial goals that you may have out there. Again, I've mentioned a few of them. Well, you should be looking at those goals and be talking, you and us together, having conversations, establishing relationships, and finding the appropriate risk model for you and your family. So through relationship is how we really figure out what's appropriate, because I think that it's a combination of, either bad information, or maybe, look, there really is something that we should be addressing on either two, maybe one way or the other, that we could be having conversations with to really target, hey, I'm fine with taking on a little bit more risk. I understand, I've got it. I want to be as aggressive as possible, even though I may be older than you suggest, Mike. Or, hey, I know you love stocks and that's the way to go, but I'm nervous. I just can't deal with it. I can't sleep at night. I need to be something more like a moderate portfolio. And I'm not going to argue with that. We're going to have a relationship. We're going to talk through that. But I want to show you at least the effect of what the expectations of these different models over time. So let's look at it together. So why would you not be in 100% stocks? Let me just answer that question first. And to do that, we're really going to talk about the lost decade. And I don't want to go back into the 1920s. I'm just going to kind of stay focused on kind of the 2000s on. We got some very good representation of a very horrible market and an incredibly good market in these last 25 years. So 2000 to 2010, we commonly refer to as the lost decade, and this is a very, very nasty time where, hey, I graduated in 2000. I became a financial advisor really right in the beginning of 2008. So perfect timing in my life to experience these right as becoming into the workforce and also becoming an advisor officially right before these financial crises both hit, with the dot-com bust in 2000, 2001, plus the financial crisis in 2008 and the beginning of 2009. So look, I'm cherry picking a horrible time, but These are the 10 years that people are talking about, and why not just be 100% stocks all the way? This is kind of what a lot of folks refer to. And so if we just look at the S&P 500, and we're just going to look right now at the index itself with the total return, dividends reinvested, it was down money. It was down about 10% from 2000 to 2010. 10-year time frame, it was down money. So that would be to say, if a client came to me now, beginning of 2025, and they said, invest my money, and we had a market just like we did in 2000 to 2010 from here to 2035, and then you were saying, invest my money, Mike, and I was just to put you in the S&P, and it happened like this, you wouldn't start seeing positive returns for over 10 years. That's what the lost decade is showing. Well, let's add in something even worse, and let's just go crazy. We're just going to put the NASDAQ in here, which is represented by the QQQ ETF, which has taken off like a rocket recently, and I'll show you that later. But this was even worse. So even in a 10-year period, this was still down half its money. So this is why I'm showing you, just in a very cherry-picked time, a 10-year time frame in which we had kind of two very nasty events, and why in a 10-year time frame this is something that is possible, and why people don't just invest 100% stocks, especially when they're getting close to retirement and they're getting older. So what can you do? Well, I'm going to take a moderate portfolio here, and now there's a couple of disclaimers and caveats. Now, this is simulated in the fact that what I've done is I've had to use historical numbers. So this is just, for illustrative purposes only. I have to say that. And I'm using a very, very, very similar asset allocation, meaning the exact same percentages that we have in our moderate portfolio, very, very similar funds as to what we're using in our current models, except I had to use funds with longer history. And so that's represented more in a Dimensional Fund Advisors mutual fund portfolio, which is the moderate portfolio shown in orange. But again, my best caveat here is just to say this should perform very similarly to what we're doing at Avantis. I just think that Avantis is going to be even better performing, is my opinion. But look, just to say, I had to compare it against something going back all the way back to get numbers from 2000, and so I had to have something with that long of history. So to compare that, I thought it would be just fair to put a moderate portfolio against 100% stock portfolio. So both of these do have an advisory fee, acting like, hey, if you had an advisor from 2000 to today, what would that impact be on, what would those percentages be in performance? And so let's just take for the lost decade, for instance, the moderate portfolio, just to say that diversification with adding international stocks and adding some bonds into the mix, 60% stocks, 40% bonds in our moderate portfolio, did give you some protection from those downsides and had a stronger, had an upside of 38% versus being down in that lost decade. And in fact, if you really wanted to cherry pick and you took both the .com and that lost decade, and you had really started from the very beginning of that 2000 and continued on, and you were moderate versus the S&P this whole time, if you really wanted to take that all the way out to today, it really wouldn't have caught up the S&P until the beginning of 2023. So yes, the stock market has done exceedingly well recently. How well? Well, if we really took the bottom of the financial crisis to today, the S&P has rocked. I mean, it's up 900% versus a moderate portfolio of up only 316% since 2008 to today. But again, it took that long. It took 23 years. If we again took this timing of both financial crisis in the mix to get up to comparison to an S&P 100% portfolio. Still, stocks won. And you could be in you could have missed one of these financial crises and stocks would have won. So I highly believe in stocks and I think it's the best for most folks. But if you did want to say, hey, look, why would I choose something different? This is why I'm pointing out that lost decade was a very, very difficult time for a lot of investors, much less the psychological impact, which we will get to in later times, of what that would have done to most folks. This is staying the course. This is never changing your asset allocation the whole time. This is just, hey, I was S&P the whole time, or hey, I was moderate the whole time, and this is how it would have performed. And I just wanted to illustrate this out to you. But yes, if you were a genius and you had just gone, started investing straight from the beginning of the bottom of 2009, you would have seen an unbelievable amount of return since then to the end of 2024 with a 900% return versus a more diversified portfolio. So it just depends on which time you're looking for, but I wanted to point that out. Just as a side note, we'll get into a much deeper dive on this because this is a real sticking point with some folks, and it's kind of a tricky one to defend lately because we've been in such a long cycle of underperformance of international stocks versus US, but we do throw in, I do put in some international stocks into the portfolios, and the reason is just this, is they've moved in cycles. We've had times where the U.S. has vastly outperformed, and we have had times, such as 2000 to 2010, where we've had international stocks vastly outperform, especially emerging markets, where we have, smaller countries did exceedingly well in that 2000 to 2010 time frame. So this helps with diversification. I will get into this in a later time frame, but I just wanted to mention this as a side note. The other one is small cap value. We do put a tilt in the portfolio towards small cap value, which is different than just the S&P 500. Why do we do this? Again, long time frame showing that we get almost double the return if we go again over a long time frame from 2000 up to today. Small caps almost doubled this S&P 500 return in that time frame. So, and another reason, by the way, is small caps have not done that well in the last 10 years relatively. So I see a lot of opportunity in the small cap value space versus the S&P. So I just wanted to mention that, to add that on to, and we'll get into the finer details of what, some of those additional smaller, breaking up of the U.S. stocks and what the, small caps versus the large caps, and we'll get into those details a little bit later. So again, just going back to the models, staying basic with it, we have this decision to make. Are we going to be aggressive, moderate, conservative, moderate, etc., or are we going to have a combination? And so I have here just lastly showing this risk reward. And I think this is really important to understand, is that these models are lined up, and you're going to see in a time frame like the last 5 years when the market has been pretty much straight up, you're going to have a lot higher returns, and you're going to have, but typically you're going to see this, greater, they call it standard deviation. That's just a measure of risk. You're going to see higher risk, but you're going to see higher reward. And that should go alongside this line very evenly from aggressive all the way down to conservative. So a lot less risky, but a lot less of a return. And this is just a 5-year time frame with the Avantis. This is the actual numbers of our Avantis funds in the mix here. And just to show you why this is important, this drawdown is a great example, and we can highlight in here to this maximum drawdown, and this is just to show you one time frame, and this highlights right here the worst that we had in the last 5 years was COVID. When COVID happened, the markets dropped very quickly, and they returned way back very quickly as the government injected a ton of money for relief for COVID. So we had a very quick fall. An aggressive had dropped almost 38%, whereas the conservative did its job. It had that ballast in there. We had far less stock exposure, and bonds held up to provide that ballast with a 17% top to bottom loss in that very brief time period compared to 37. So just to show you, less volatility the more you go down, but less return when we have these up markets. So give me the bottom line. All right, so I'm going to finish this all up to just give you the statistically the bottom line without conversation. You know, what would you just do if you were me, kind of thing? And I get that question a lot from clients. What would you do if you were me? And I'm just going to give you the bottom line. And what I recommend is, you know, typically if we remove the emotions, extreme emotions that some people may have in a particular given time, I say I would stick more with the age and just say, look, if you're under 55, you're not close to retirement, I would recommend staying aggressive and moderate aggressive. Stocks have just won out the day in long time frames. And if you're 55 or under, you have the time. You have, you know, we're planning at that time, 55 or under, 30 plus years of investing. So we've got plenty of time to overcome market volatility. You know, again, we had once in a generation, much less, almost never had seen a financial crisis except for one other time in U.S. history, like we saw in 2008. It could happen. We have no idea what is going to happen in the future, but those were extreme examples. So I think under 55, 100% stocks or 80% stocks, more than appropriate for under 55. However, when you get closer to retirement, the tricky thing about losses is that you're thinking about making withdrawals as well from a portfolio. And that's where withdrawals, in addition to large market losses, really does disrupt your ability to, you know, really make sure you have enough money for retirement. And so that's when I say, when you're getting close, 7-10 years, somewhere in there towards retirement, we start implementing a bucket bliss strategy. And I will go into this in another video later, but we're just basically going to incorporate more conservative models. But again, this is based on our financial planning and based on very specific income needs that you will need in conjunction with your whole financial plan, your social security that you may be getting, a value of you and your spouse and your family needs, your expenses that you may need in retirement. It's different for everybody, but we will be constructing this kind of strategy and figuring out how conservative you need to get over time once you're getting close to retirement. And that's what I'm using those more conservative buckets for. So I hope that explains really how I'm looking at asset allocation. The reason I really want to mention this especially is that when we're talking about markets, you know, there's a lot of different markets out there. It's not just U.S. stocks. There's international markets. There's bonds. You know, there's small cap stocks. There's very different variants in each of these sub asset classes. When people are on the news, they're on the radio, they're usually typically talking about the S&P 500. It's one sliver of the overall investable market. So I want you to understand, like, hey, if you're a moderate portfolio and they're talking about the markets going down, well, that's only 60% of your portfolio. It's not the whole thing. So just understand where you're at from your asset allocation, and we should know what that is across your whole net worth, meaning what your 401k is, what you have either at Altruist or Schwab with Perfetta, and knowing where you lie and knowing when those those asset allocations should change the closer you get to retirement, I think, is the more winning strategy. Okay, the last point I'm going to make here is just that what I don't want to see clients do, and I've seen this over and over and over again, and we're going to talk about different strategies and what else is out there, and exactly why I'm recommending what we call more of a passive strategy, sticking to these asset allocation models once we make our decision. This is very critical, because what happens is a lot of times we either get in these over exuberant modes, or we get into these over fearful modes where we see a financial crisis like we saw in 2008. We panic and we think, oh, well, we need to move. We need to move out of stocks. Forget it. I want to get out. I want to go from aggressive to conservative. And then you're getting into this cycle of trying to time the market. And that is a recipe for failure. And I've seen it over and over again. I've been in this business for a very long time. I've seen it happen to too many clients. I've seen it happen over and over again to very sophisticated asset managers trying to implement these strategies, either through the use of different modeling techniques through software. They've gotten killed. They have not beaten these buy and hold kind of strategies, these passive strategies over time. So my encouragement is once we settle on, hey, this is our expectations, this is where we're relying on our asset allocation model portfolio, that we stick through and follow the plan rather than following our emotions. And so, if we can't fathom the possibility of, in a short period of time, our portfolio going down 50%, you shouldn't be in 100% stocks from the beginning. You should be more of a moderate. And then that way, and then sticking through that throughout the whole process, until maybe we get into retirement. That's the only time I think we should be changing asset allocation models, because we're preparing for income needs. So I just really want to knock that point home. We're going to be getting a lot of that into future videos, and the behavioral aspect is huge. But really, my wholehearted guidance here, my strong opinion, is do not move from, bouncing around from one model to the next, depending on the latest market movement. It is a recipe for disaster. This is why why you have an advisor. You have an objective person. We can talk through these things together. We have a diversified portfolio to try to help with mitigating some of those things. But we can only do so much. We don't have a crystal ball. And the diversification plus the ballast of using bonds that's what we can do to prevent downside. And we've got time on our side for the upside if we want to be aggressive. So that's where I'm going to leave it for now. If you have any questions, if you'd like any backup material on this, I do have a lot of it. But again, a lot of this goes into the weeds, so if you want something from me, you request it, just email me. I can give you some of this, like the model history going back. I've got it all, but I wanted to keep this as simple as I could, and just kind of show you from the beginning where we're going to start with the models, and then we'll go into some deeper dive later on with some more stuff. So I hope you appreciated this, and again, if you have any questions, reach out to me, let me know, and look forward to seeing you on the next one.